Hello everyone. In this presentation, I shall discuss and explain all about the international trade economics. We shall also see what are the benefits from the international trade and who actually gains and loses from international trade, and further all the advantages and disadvantages emanating from international trade. So let's go right ahead. So apart from discussing the economics behind the international trade, as we shall see in the course of this presentation, the answer to what are the disadvantages and advantages of international trade, as well as about the winners and losers from international trade, would very much depend upon what stage actually we are in of the international trade. Few decades back, when global international trade was in its infancy, specifically between the developed and the developing world, the international trade was overall a positive sum game. After the globalization phenomenon related to international trade has matured, calling international trade as always a positive sum game may not be correct. And so, as we shall see, international trade can have all the three states, that is, a positive sum game, a zero sum game, and even a negative sum game. Even if international trade overall is a positive sum game, there are bound to be winners and losers. We shall divide this presentation into three broad sections or parts, which would represent distinctive stages of the international trade. So let's first see how the exchange rate, which is a very basis of the international trade, behaves between two economies, in this case US and China. Let's take an example, when there is not much of international trade going on, or in other words, the demand of the two countries are pretty much satisfied by the supply, um, by the production supply within these countries. So in that case, let's assume that the amount of credit required for production of X amount of goods in US is quite less when compared to the amount of credit or monies required to produce the same amount of goods in China. Or in other words, the productivity in US is higher than the productivity in China. And so since the demand is pretty much satisfied in this case by the internal productions, we would say the exchange rate of US would be gaining in strength overall compared to the exchange rate in China. Now let's bring the international trade into picture. How? In this case, let's assume now that the demand in United States is not, the internal supply or internal production in United States is not able to facilitate that overall demand in United States. So that would mean a trade with China in this case. So now China would be shipping in goods and services to US, and in return US would be sending in the dollars or the money to China. Let's see how the players stack up. And these players would play a role in all the three parts of this presentation. So there will be the outsourcing companies in US, companies who outsource the production of goods and services to China. There will be the companies in US who will export goods and services to China. Yes, some will be there in US as well. There will be workers who will be working in the outsourcing companies in the US. There will be workers who will be working in the exporting companies, that is, companies that will export stuff to China. And there will be some workers who will be out of job because of all this process. And finally, we have the government and the central banks of US. And yeah, let's not forget the most important ones, the investors and the bankers in this entire process. Now, who are going to be the players in China? First, there will be the export companies in China who will be exporting goods and services to the US. there will be companies who will be importing goods and services from the US, and the companies who will be producing goods in China to cater to the domestic markets in China. Then there will be workers working in the exporting companies in China, workers working in the importing companies, that is the companies who will be importing goods and services from the US in China, and workers who will be working in the companies that will be catering to the domestic markets of China. And finally, we'll have the government and the central bank of China. And yes, financial institutions like in the US will be also there in China. So we shall overall club them together. So initially what happens? I will request you to check the presentation on modern monetary theory to see how government spending and monetary support leads to optimum utilization of resources in the domestic economy, especially when it's closed domestic economy. Now something similar happens, but this time because the economy is open and international trade is going to take place, this will happen in China. That is, because of the slack of resources in China, the optimum utilization of resources because of government spending in US will start to happen in China. So, when the government in US increases its fiscal deficit, or for that matter monetary support by the central bank, the demand in US will rise. And this demand will be catered to not by domestic production in US or very little by domestic production in US, but this demand will be catered through by the production increase of supply of goods and services from China due to the international trade. Also, because the cost of production of goods in China is low, in spite of the lower productivity, prices in the US market will also decline due to cheaper imports. Now let's see how the trade will flow. China will be sending in goods and services to US, and at the same time would be sending in kind of deflation or lower prices to the US. Thus, this will allow the government to increase its fiscal deficit even more because of the lower prices. Also, this will be a two-way flow. How? China would also be importing some goods and services from the US that are probably high-tech in nature. Also some raw materials, agri products that China can import from US, and then in return it will be sending some of the same dollars that US shipped over to China. Now, because of the reduced inflation levels in the US domestic economy as a result of cheaper goods imported from China, the government can now afford to increase the fiscal deficit. Fed can monetize this fiscal deficit or the government debt. So, the government increases its fiscal deficit, thereby increases the debt level, which the Federal Reserve can buy indirectly maybe from the private participants in the financial markets through freshly printed money, which it can credit into the government account. In modern day, it's also known as QE or quantitative easing. Another way in which the government can fund its deficit, increased deficits, can be through the debt, which can be bought by both domestic and foreign investors, including the Chinese investors, of course, who will credit the money in the account of US government. Also, let's understand how the capital flows will occur. So, since China is sending in the goods, US is sending in the dollars, that's the current account. In the capital account, US will be kind of sending in the debt, the US government debt, the corporate debt, and its equity of the US companies. And Chinese investors would be buying in using the same very dollars. So let's talk about who the gainers are and how they stack up in US. Biggest, I would say, the gainers are the financial institutions. Why I say that? There will be increased financialization of the economy as there will be more debt in the economy. Less inflation would mean more money can go into the financial assets. Also, the productivity of the companies will increase overall because of this. And overall, there will be more companies in China as well as in US. So the nature of companies in US would change. Also, the outsourcing companies in US would be gaining tremendously on account of their increased profitability and higher equity prices. And then the export companies in the US, even they would be gaining because there would be more demand for their products in a new geography that is China. As new markets are opening up, they'll be gaining as well. What about the workers? Well, even the workers for that matter, workers who will be working in the export companies of US, the companies that will be selling goods to China, they would be gaining as their growth potential would increase, and also they would be buying cheaper products than what they had been before. So overall, their living standards would be higher. Then workers working in the companies who are outsourcing stuff to China, even they are good enough because the prices of products have come down, their salaries might be kind of stagnant. So overall, their living standard is higher than before. Yes, there will be some workers who would be out of their jobs because of this. Some workers who would graduate to the companies who will be selling high-tech stuff to China. Yes, there will be some workers for that. For them, it will be a good deal. For some workers who will be working in lower-end jobs now, in service industry, for example, and workers who are out of job, for them, it will not be that great a deal, obviously. However, because the prices of products have declined, US government has increased its fiscal deficit so the jobless workers can get the government support, and coupled with the fact that the prices have declined, and if they own some equity or some other asset in terms of real estate, those prices have shifted higher. So I would say even this category of workers may not be better off, but at least initially would overall not be worse off. So in total, because of the initiation of international trade, more or less most of the participants in United States have overall gained, or some of the participants have overall their living standards have remained the same, but on total things are much better. Now let's take a look of what happens to the players in China. Of course, the financial institutions have gained like before. Now the companies which are exporting goods to the US, obviously it's a new business for them. The opportunities are great, equity prices are shooting up, it's a great time for them. Also the companies who are importing goods for them from US, they are getting newer opportunities. Companies who are producing goods for the domestic markets of China, their market is gaining new grounds, and it's a great time for even them as well. What are the workers? Well, the workers working in the export companies, it's a good time for them. They're getting good money. Newer opportunities means more employment opportunities. Their pay scales are rising. The workers working in the import companies that are importing goods from US, again, they are getting more and more opportunities, and it's a good time for them as well. And finally, the workers who are working in companies that are catering to the domestic market of China. For them also, the growth potential is higher, more employment opportunities, and a great time. So overall, great thing for almost all the players in China. And in the US, as we discussed before, great things for almost all the players in US. So, what's the conclusion in this part 1? At the time of initiation of global international trade, it's a positive sum game. There are winners in US, China, internationally, and overall. The biggest winners are the financial investors and bankers, the companies in US and China, followed by workers in China, and large parts of the workers, I would have to say, even in America, gain because of their higher living standards and more business opportunities. Yes, some workers in America will lose, but those out of job workers and workers who will be moving out to a lesser paying job, their living standard would still be maintained, but the government support due to the government that can afford a higher fiscal deficit and a lower inflation, ensuring their living standards that is close to what it was before. So a quick recap. We saw that when international trade starts between countries with stark productivity differences, international trade is usually good for both the countries and overall for almost all the participants in the economy. So as now the international trade progresses further, the exchange rate of the importing country, which is the US, would should have started declining, and the exchange rate of the exporting country, that is China, would have started increasing. Also, we would see that since the US is importing goods and services and China is exporting goods and services, so supply of goods and services in US would increase relative to the money supply in the United States. Thus, the inflation levels in United States should have declined. And while China is exporting goods and services and importing money, the overall money supply in China would increase compared to the goods and services produced in China, and hence inflation should have gone higher. And even that should have reflected in the exchange rate. Now, so what would have happened? Well, China now, as the international trade matures, should, apart from supplying goods and services to US, now should also be sending in inflation back to US. In a normal scenario then, because of this, as the inflation of imported inflation would have risen in the US, the overall demand for those goods and services in US would have declined. And as the demand would have declined, so would have the imports. That would have meant that the exchange rate would have then readjusted itself, thereby increasing the dollar price vis-a-vis the price of Chinese yuan and shifting some of the supply back to the US. That would have happened in a free exchange rate regime. However, in reality, this adjustment process is not allowed to take place. Since the yuan has been kept in a fixed or relatively tight range, what happens is the inflation levels in US is steady, while that in China rises even further. So this policy of keeping the exchange rate relatively fixed by China has a big side effect, which is the loss of efficacy of the US fiscal and monetary policy. Let's see how. So, the United States government, let's say, increases its fiscal deficit, or in other words, takes in more debt. Now, let's also say that that debt is monetized by the central bank. So, increase in the money supply, thus both combined leading to an increase in the domestic US demand. Now, in a relatively closed setup, or in a setup where the exchange rate would have been allowed to float, that would have meant that the supply in US would have increased, thus raising the growth in the domestic economy of US. However, since most of the supply has been now outsourced to China, because of increase in fiscal and monetary policy, the supply in US remains almost steady. That means the growth in US doesn't respond to the fiscal and monetary policy of US by a great extent. Let's continue further. So that means the imports, that increased demand is being satisfied by the increase in imports into US. Now, since the exchange rate is kept steady by China, that would translate into inflation, domestic inflation in the US, or the imported inflation in the US being steady again. And hence, the demand will not fall at all, even in spite of increase in imports, while on the other, or as time progresses, it will keep on rising because of the fiscal and monetary stimulus provided by the US. And so, in spite of the monetary and fiscal stimulus provided by the US, since the domestic supply of the US is not responding much, the growth in US economy doesn't increase by much. On the other hand, where the effect happens, it happens in China, as the Chinese growth would increase because of the fiscal and monetary stimulus in United States. So, as the international trade progresses in the setup of almost kind of a fixed exchange rate, what's happening? What's the impact on players across geographies? In US, the financialization still carries on profitably. Though some companies' profitability starts to decline, but overall it's good for financial institutions and banks. Outsourcing companies in US, because the exchange rate is fixed, the profitability of these companies is good. Though some profitability hit happens because of increase in inflation in the domestic markets of China. Exporting companies in the US, which used to export goods in China, are not doing so great as before. Still okay, but not so great. Reason? There is a decline in the demand for imported goods because of the rise in inflation in China. And the exchange rate is not also favorable for the Chinese people. The workers who are working in the exporting companies, hence in the United States, are not doing so well as the demand is not so great anymore. And some also start to lose their jobs. While the workers who are working in the importing companies, the outsourcing companies in the United States, are still doing fine. The product prices are still low and they have their jobs, so they are still doing okay. And so overall, the workers in the United States are not doing as great as before, as the status of workers who were working earlier in the exporting companies has declined. There are workers who are, more workers are out of job, and so the overall status of workers in United States has declined compared to what it was when the international trade had started. Now, how are the players in China doing? The financial institutions, great again. Now, exporting companies from China are also doing well, though again their profitability has declined because of the increase in wages and in domestic inflation. The companies who cater to the domestic demand in China and the companies who are importing goods from US, their companies are not doing good at all because of the higher inflation in China. The workers who are working in the exporting companies in China are not that better off as before because of the rise in domestic inflation, but still okay. Workers who are working in the companies that used to import goods into China are seeing tougher times now. And finally, the workers who are catering to a domestic demand in China again are seeing tougher times because of the lower demand, domestic demand in China on account of higher inflation. And some would even start losing their jobs. So in conclusion of this part 2, international trade now is no longer a positive sum game. Although things are much better than what they were when the international trade actually had started or began, but they have started to deteriorate as well. The financial institutions are still gaining, but there are some set of companies that are gaining, while on the other hand, there are some set of companies that have started to lose as well. Similarly, some set of workers are still okay, while some have started to lose in this international trade game. The gains are now increasingly getting concentrated on higher levels, that is, bigger financial institutions, bigger companies involved in specific kind of businesses, and more or less at the government level as well. Overall, the exporting country does slightly better than the importing country on a cumulative basis, as the fiscal and monetary policy of the importing country starts to lose their efficacy, especially in the fixed exchange rate scenario. Now, as international trade is a very important ingredient of globalization, because of all this, what actually happens to globalization? So, as the benefits of international trade become scantier and increasingly skewed towards some big players like the financial institutions and limited amount of big companies, advantages of globalization starts to look very murky. Now, instead of taking a step back, as even then the beneficiaries of globalization try to advocate and force it on the masses using the influence gained over the decades by being in the power setup, we see a backlash against globalization starts to grow. So, like everything, even we have to understand that even globalization is also cyclical, even as there is a secular trend upwards. So we are currently in the waning part of the cycle of globalization, and in this cycle nationalism starts to gain currency, and the global elites occupying places of influence, maybe due to good work or due to the influence of their progeny, starts to lose influence. So a quick recap of the first two parts. We saw that at the beginning of international trade, it was a positive sum game for all the economies and largely for most of the players in those economies. Later on, especially in a fixed exchange rate regime, it started, that is international trade started to get less and less positive, as the rewards were more skewed towards the bigger players in the economy and also towards the exporting country. It's less stark in floating exchange rate regime as adjustments take place, but it is present even there as well. Also, the fiscal and monetary policy of importing country starts to lose their efficacy as it ends up benefiting the exporting country much more. So in this part, before we finally get into the crux of the situation, let's quickly see what happens when there are malinvestments in an economy, inside a closed economy, and the credit adjustment starts to take place. So let's say a person who has taken loan from the bank and the bank has given the person the loan. Now, because of economic slowdown and various other reasons, malinvestment has happened in the economy, and when the bank asks for its loan back, the person is unable to give the loan. So then what happens? The bank would then take up your collateral, right? And it would sell that collateral to some other participant in the economy, let's say a player B. So there's a wealth transfer that happens from person A to person B. Some credit is destroyed in the economy and deflationary pressure, at least to some extent, gets built up. Let's take the situation a step further, and let's say that the malinvestments in the economy are much more deeper, in which case in which case the value of the collateral is insufficient to meet the value the bank has lent to the person in the first place. And so this time the help of the private investors is taken place as the bank issues more equity, and so the value of existing equity holders decline, and in other words there's a wealth transfer from this time from the debt and equity holders or investors as well, and more credit is destroyed. So in other words, the deflationary pressure is much more in this case. And finally, the third level. In this case, even the equity holders and the investors overall are unable to help out the bank. The stark malinvestments in the economy is pretty high. In this case, the federal government has to intervene. And they in turn buys equity in the banks and in some cases some companies as well to prevent them from falling. And how they do that? Essentially using the taxpayers' money. And why are they forced to do it? Because otherwise the impact on economy will be huge, as the depositors in the bank or common people will lose a large amount of money, because the banks would be forced to write off a large part of its balance sheet, and that could lead to an economic crash. Now let's keep this scenario here and instead replace the federal government of US by China. The malinvestments because of the domestic inflation in China as a result of keeping that exchange rate constant is so stark and so huge that now the Chinese government has to enter and save its economy. And the prime way it's going to do that is by selling the dollar and its forex reserves, which are in the form of debt, US debt, and foreign equities, which will then decline in price. So the question is that the only option towards China? The answer is of course not. There are three broad options that China has. However, the option given in the previous slide is the best possible of those three options. Let's see what are those three options before China. Under option 1, China can increase its debt further and monetize that debt, a process that it has been doing till now. So what the option is, keep on doing the same process. Keep kicking that can down the road. However, what will happen? And it's not a very distant fantasy, it's very close to the horizon what we are seeing. What will happen? Because of that increased money supply, the demand will increase further. Increased demand can lead to even higher inflation, given what we are noticing that China is fast approaching, a behemoth like China is also fast approaching what we call supply limits in its economy. So it will have two options, either to increase its imports further and dwindle its dollar reserves, something that it has been trying to avoid, or given its supply constraints, accept this inflation and let the economy traverse into a stagflationary spiral or even worse. The second option is the option we gave in the previous slide, that is, reduce its money supply by selling down its forex reserves in the form of debt, forex debt, foreign debt, and foreign equity. That would put pressure on the interest rates globally. So interest rates would rise in foreign markets as well as in domestic market. This would lead to a slowdown in growth, no question about it. A slowdown in supply given the higher interest rates and a slowdown in growth. And as the money supply is also coming down, it would also lead to a decline in demand. However, given that there is also a slowdown in growth or supply and a slowdown in demand, what will happen to inflation is an open question. That is, will the demand fall? Will the fall in demand compensate to the fall in supply or not? Inflation would depend upon that scenario. We can't answer it right now. And the third option, China could reduce its money supply in two ways mainly. One, as we have seen in the previous slide, by selling its dollar reserves in the form of foreign debt and equities. Or it can also draw down its domestic debt and hence reduce its money supply. However, reducing money supply by drawing down its domestic debt can lead to a severe bout of deflation and can then amount to an economic depression in China, an option I'm sure certainly China would like to avoid. So one question that can come to your mind, and we have touched upon it briefly in the previous slide, is why can China inflate infinitely? Or in other words, why can China keep on doing the same thing, inflating its money supply domestically more and more and keep on rolling the ball further and further? After all, it can manage the public backlash even if there's a high inflation in the economy given its political structure. The answer is it can't. Economic gravity. And by that, what I mean? If one increases the money supply, that leads to an increase in demand. Even for the most basic goods, we have seen like food, basic materials, energy, the imports of Chinese imports have been rising gradually over the years. Domestically also, even for a country whose supply side spectrum is as vast as China, we are seeing the Chinese economy touching its boundary limits. So in other words, the supply side of China is reaching its boundary limits even as its demand is increasing. So what it would mean domestically and perhaps even internationally is that it can lead to a supply shock, which means more and more inflation, which can either be addressed through further increase in imports that actually would put further pressure on its dollar reserves, ironically, which it's trying to avoid, or rationing, literal rationing of its domestic supply. So the two options lead more inflation, leading to either rationing of supply or vanishing of current account surplus from China and pressure on its dollar reserves, which it's trying to avoid. So there are no good options. In any case, going down this route will put pressure on dollar reserves of China. There is no question about it. This chart is the current account as percentage of GDP of China, and as we can see, since somewhere in the middle of 1990s, early 1990s, the current account of China started rising, reached a peak, and then has started to fall. So the process is already on. Of course, extraneous shocks can accelerate this process even further and faster, but it will happen in absent of any exogenous shock. It would have happened anyways in its due course of time. The exogenous shock makes the process faster. So out of all the three options, option 2, as we can deduce, that is reducing the money supply by selling dollars, is the best option for China ultimately to go about. If it goes for option 1, it messes its economy even more, and ultimately the dollar reserves anyways dwindle, if it goes for option 3, as we saw, it will lead to a deflationary cycle and perhaps even an economic depression, something that no country would like to have. Hence, we can deduce that dollar is actually the chalice of life, or the bloodline for China in this case. And because this is what China needs to manage its domestic inflation, its supply and growth, investments, and even in global influence. And when I say China, by the way, because China is such a behemoth, I mean to say all mercantilist countries adopting similar kind of models. And that is why China has actually been keeping a tight leash on its capital account ever since. And it's increasingly becoming hard for the foreign companies to move large amounts of dollars outside China over the last few years. So to compensate for, as we have seen in the previous slide, how the current account of China has been slipping. So to compensate for the slowdown in dollar inflow from the current account, China is actually trying to increase dollar inflow through capital account. How it is doing that? By listing Chinese stocks in US markets, putting some influence and increasing weightages in various global indices, MSCI, etc., which are actually used as benchmark by various fund managers to invest in stocks and markets around the world. And as we have discussed in the previous slides, the global shocks make the situation worse and accelerate this process even faster, thus putting all these mercantilist countries and economies which are in a precarious situation in even more perilous situations over the next few years going forward. So in conclusion, we can say that international trade in the given system turns from a positive sum game finally into a negative sum game. The final adjustment process could be brutal and arduous at the same time, as domestic supply in the importing country would take some time to build, leading to a decline in growth. Possibly, the inflation in the importing country can rise, though it would, as we have seen, it would depend upon how little or more the demand would remain constant, or in other words, how much of the demand is inelastic or elastic, and hence inflation question is still open. In the exporting country, however, a deflationary scenario is on cards, with the fall in business and unemployment. If, however, any other route is taken, it can lead to a bigger catastrophic situation for the exporting country. So overall, international trade can remain a positive sum gain for longer if the complete free market practices are allowed to be followed, that is, no exchange rate manipulation. Even when there is a free exchange rate policy, like any economic and business cycle of international trade, the international trade cycle would also follow the same rules. That is, there would be rewards and there would be risks. There would be highs and there would be lows in the economy. However, if the markets are manipulated, as we have seen, then the cycle would be longer. Both positive and negative cycles would be longer, and the negative cycles would be pretty brutal and last for a longer time. So thank you very much for watching these presentations. Do subscribe if you like such content and comment in case of any questions. Thanks a lot.